This is Financially Fit Radio with Cory Sickles from Safe Harbor Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Cory provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Retirement Group and Wealth Advisors. If you'd like any information that we talk about today, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, feel free to click on that radio page. You can check out some previous shows, as well as subscribe to our show on Apple Podcast, Amazon Music, Google Podcast, or Spotify. Also, feel free to visit our YouTube page. Just type in Safe Harbor Retirement Group. You can watch today's show, and you can watch previous shows as well. And you can also subscribe to our show and be able to keep up to date with our Financially Fit shorts. We're putting about 3 or 4 of those out a week as well. Just remember, we're here to help and guide you to make sure you have the best retirement that you can possibly have. And the best way to do that is to give us a call, again, at 614-760-0670, or visit us online at safeharboroh.com to set up a complimentary no-obligation meeting with me. Well, today we have a special guest from Directional Investments, Jeremy Bryan, and we're going to be able to talk about our buffered index product. We actually had someone call in or actually send me an email personally and want to know more about it. So I think it's a good time. We haven't talked about it in a while, but before we dive into that, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you doing? I'm sure you're doing all right since the Vikings are winning.
I'll tell you what, I am doing better than just all right. I'm doing fantastic for 2 reasons. One, the Minnesota Vikings are 5-0. Right now, we are the only 5-0 team. We have the best record in the NFL right now because as of this recording, Chiefs play tonight. So we'll see. We'll see how that goes. But the second reason I'm doing so well today, Cory, is because this show is going to be one of the best we've done because of our guest today, Jeremy Bryan. What a huge get this guy is. Senior portfolio manager, and I can't wait. Jeremy, I'm so glad you're here. I even have a special intro. Being the senior portfolio manager at Directional Investments, we're going to play this for him.
Look at this. Technology is a wonderful thing.
I love
it. Is.
I love that. That's for Jeremy, our guest today. So I've been good, but Cory, how have you been before we introduce Jeremy officially here?
I'm doing good. I have one little thing to ask you, though, Tony. Do you want me to actually give you good news or some bad news about being 5-0?
Oh, okay. The good news is
The good news is about 85% of the NFL teams actually make the playoffs when you start 5-0.
Uh-huh.
The last team that did not make the playoffs to start 5-0?
The Minnesota Vikings.
Yes, 2016. I did a little homework before today.
Oh, I know. We're well aware of 2016. So
you finished 8-8 that year.
Yeah, we did.
But things are good.
Still 500. Still better than either of the Ohio teams will probably finish this year. 8-8. What do you think?
Browns are definitely going to probably be under. The Bengals still have a chance. They've lost 4 games by a total of 15 points.
That's true. That's true. I just can't believe I watched both games, and I really thought the Bengals could do it, and it's just they've struggled or had some bad breaks. But again, a lot of teams that start off like that, they can finish the year strong. They just have to make some adjustments.
That's why we always can count on the Buckeyes on Saturdays.
Yep, Ohio State.
NFL's too bad.
Yeah, and we're not going to compare college teams.
Yeah,
let's stick to comparing pro teams because if you're from Minnesota, you don't want to compare your college team to Ohio State, especially.
Hey, the Gulfs just ran the field, man.
Yeah, they did.
Being an 11 seed team, and we stormed the field, which tells you a lot about our team. But nonetheless,
we defeated the 11 seed, and the the place went crazy, like we'd won the
I'm
Super
sure.
Bowl. I mean, it was like a Super Bowl victory at that point.
It's probably one of the biggest wins they've had in a while.
Yeah, the Gophers, we've had a few, but in the past few years, where we'll beat Michigan or Iowa or something. But yeah, no, that's huge. And Ohio State, they're ranked. I mean, you guys are
2-3, got Oregon.
Yeah. So that's
Yep.
awesome. All right, well, let's introduce that guest. Tell us about our guest today, Cory.
Well, one of the things that we do, I guess, from our investing standpoint, and for what we actually invest in the market, we have a relationship with Gradient Investments. Actually, Jeremy's going to be coming up here in a couple weeks to speak with some of our clients. But one of the benefits that we actually have with our clients is it's not too often that you can actually speak with somebody that actually manages money. And Jeremy's been doing that with us. How long have you been with Gradient, Jeremy?
8 years now. 8 years.
8 years.
Wow.
8 years. And he's a senior portfolio manager. And when we start talking about different types of products, like the buffered index we're going to talk about, he kind of leads that up at Gradient Investments. It's something where you have, how much money do you have invested in the buffered products today?
Our assets under management are now slightly over $1 billion in there. So
$1 billion,
quite a big product for us.
In the buffered index,
Mhm.
$1 billion. Wow.
And you're about $6.5 billion overall that you manage.
Yep. That's it. You nailed it.
So when you start really thinking about it, I mean, one of the things that I'll just kind of tell you why. We'll get into what the product does here in a minute. But one of the things that I like about it more than anything else is a lot of people, as you age and as you get into retirement, they don't want to be invested totally in the market. So some of the things that we'll talk about today, this allows you to still be in the market, but you're going to have some type of protection when the market goes the other way. And we'll talk about liquidity and things like that. But at the end of the day, it's a good way to still be able to keep up with inflation. Keep up, obviously interest rates are going to be going down and people are going to be looking at different ways in order to make money, to keep up with inflation. Hopefully inflation is not like it was, a couple years ago going forward.
Right.
But, but even if you have a 2 or 3% increase, I mean, we lived through this, for the last 10 years before really they started raising interest rates in 2020.
Mhm.
And that is you couldn't make anything in the bank.
Right.
So, how can you keep up with inflation if you're making 1 or 2%, from your CDs and money markets and things like that? So, we offer 3 types of buffered products, and we'll talk about each one of them. In the first one, I do want to talk about, Tony, let's just talk about the regular buffered product.
Sure.
The buffered index product. And why don't you just kind of tell me, explain maybe on a cap, what a cap means to someone that wants to invest in this product, and what the buffer actually means too.
Yeah, it's a great question because it sets up the structure of everything, right? Is that, as you said, Cory, this is an excellent product for somebody who wants to have participation with the markets, but also wants some level of protection in case markets, as they tend to do from time to time, fall on real difficult times. So really what the buffered index, and you start out with the traditional, is what we call the traditional buffered index, which has a cap and buffer. We'll go into the other ones here in a second. But the buffer is the level of protection you get. So we could set it at 10%, 15%, and all the way up to we have 100% principal protected buffers. So we can customize the level of protection that a client would want. And so from our perspective, let's say it's 15%, right? Well, let's say it's a 2-year buffered note, a structured note that's 2 years in length. Well, at the end of that 2 years, if the market is down 12%, you are within that buffer territory. You aren't going to lose anything from that particular note. If you fall below that buffered level, let's say the market is down 20% during that time, well, you have that 15% level of protection. So you would be down 5%. So you would start losing beyond that 15% mark. So it provides a level of protection. Now, how do you pay for that level of protection? Is you get what we would call a capped upside. And that just means it's subject to a maximum return level that if the market goes above that level, you are capped out at performance. So, for example, on the other side of that coin, let's say the cap was 20%. And on a 20% cap, let's say the market's up 12. Well, you're going to get that 12%. That's what you would get at the end of that 2 years. But let's say the market was up 25%. You would give up that 5% and you would get a return of 20 at the end of that 2 years. So it's really a structure that, again, provides that level of protection, but also relatively substantial upside up to that capped level. That's what this is designed for, is, again, as Cory said before, a lot of our clients are near or in retirement. They're much more concerned about being able to replace things from very negative markets, but still want to participate in markets that are positive. This allows them to have that opportunity, and that's why we've seen such success with it so far.
So are there actually caps that are that high, 20%?
So
that seems high for a cap on a product like that.
It very much depends on the amount of protection you want to have, right?
Sure.
So for 100% principal protection, right, no downside risk, the caps are going to be lower.
Sure.
The less protection you have, the higher the upside.
Okay.
So we've had offerings that have had 10 and 15% downside risk, or excuse me, downside buffer protection.
Sure.
But have had actually uncapped upsides where, hey, there is no cap to this thing.
Right.
So it really does depend. There's a lot of different factors about the things we can offer. I won't go in too far into the weeds and bore everyone here.
Right.
But from that side, we can offer a lot of different levels of protection for people who want to be more conservative or who want to have a little bit more risk and take the chance that you might get better upside in the future.
Wow.
Yeah,
and so that buffered index is for a particular period of time then?
Yeah, exactly.
Sure.
And it's always known beforehand. So you know your level of protection, you know your capped upside, and you know your time to maturity. So it's always known beforehand.
Okay.
And we do and one of the things that Jeremy does, he goes out and negotiates these. And then we have monthly offerings.
Mhm.
So we might have, for this upcoming month, I think we have an 18-month, we have a 24-month, we even have a 5-year month.
Mhm.
Or a 5-year term. So one of the nice parts of obviously about this is you have different variances depending on what the client's trying to accomplish, and the most important part is where are you in life. If you're 50 years old, a 5-year index might actually end up being good. And here's the one thing I would also say is, if we say we're in a 2-year index. Just to make sure everyone understands this, the only thing you really care about is the begin date and the end date.
Exactly.
So, I mean, the market could drop 25% 12 months in, but you have time for that to come back to meet your parameters, maybe where you might not lose anything.
Mhm.
Or maybe at the end of the day, you might end up making something as well. What type of indexes are you looking at with these type of products too, Jeremy?
Yeah. So, if you take structured note, really you can design it any way, shape, or form you want. It's just a question of what you want to do. But from our side here at Gradient Investments, we've really tried to make this things that people can understand relatively quickly. And so from our side, really what we're concerned with when we use indices, we use indexes that are publicly known, S&P 500, Dow Jones, NASDAQ, these kinds of things where people see them on a daily basis. If they go to CNBC or if they're watching it all and those kinds of things, they can find those indices. They know the returns. They know what they're basically kind of are. So we really try to keep them to that, to those indexes so that people understand, hey, we're taking a similar level of market risk that we're doing in the other stuff that we're doing. We just have a predefined level of protection and a predefined cap, if there is one, on the upside to the maturity. So we really try to keep the indexes, for the most part, things that we know. And in the instances where we don't, we will do a lot of explaining and education about what those indexes are, how they work, and when they don't work. We try to be as transparent about that as possible.
Yeah. So a minute ago we just described the basic one, which is the buffered index,
Mm-hmm.
and now we also have one we actually call the dual directional. So explain the difference between that and this, and then I'm already gonna ask you a question you can answer. Because I get this when I explain the dual directional to clients and they go, this seems like it's too good to be true.
Yeah. Yes. Yeah. I'm often, whenever I talk about the dual directional, it's like, how do you do that? Because really 2 of the situations are exactly the same. In fact, 3 of the situations are exactly the same. So let's go beyond the level of protection. So let's use that 15% buffer again, just like we used in the traditional. Well, that 15% buffer, if you're down 20%, you would lose 5%. just like the traditional. On the upside, again, you get upside to the capped level. So let's say the capped level is, again, let's just use that 20% as an example again. If the market was up 12, you would get 12. If the market is up 25, you would be capped out at that 20. So right now we're at the exact same territory as the traditional. Where the dual directional is different is what I like to call is within the buffer zone. So that 0 to minus 15%. Within that zone, you actually get what we call the absolute value. It's just a fancy way to saying you would flip that. You get the inverse of that return. So if the market is down 7%, that is within that buffer zone, you are actually going to get a positive 7% return. Wow. If the market is down 13, you're going to get a positive 13. Now, where this changes is if the market falls down at maturity, falls down to minus 16, you would be beyond that buffer zone and you would lose 1. So that's where that is the biggest difference. And that's where, Cory, as you said before, people are like, wait, that you can't do that. How do I make money when everyone else is losing money? And people, the second question I get all the time is, why would you ever issue a traditional one when you have the dual directionals? And the real simple answer for that is dual directionals, because of that ability to make money even in negative markets. If the exact same terms were issued, the cap would be higher on the traditional note as opposed to the dual directional. That's what you have to pay a little bit more for, that protection element. That's the difference. But that's why we offer both. Is some people are like, no, I want to have the higher upside in the traditional component. Some people love the fact that, hey, if the market's down within that range and I don't lose anything, in fact, I gain, I'm taking that all day. So we just want to offer people choices in that manner. And so that's why we offer both on a regular basis.
Wow. So in a dual directional, if I have this right, so if I'm within the buffered zone, so a dual directional, let's say the bottom is a negative 15, I'm protected up until that the market drops 15%. I'm protected to that point. If it drops 7, I'm up 7%. I get a 7% gain.
Correct. It's always at maturity. So you always want to stay to the maturity. But yes, if you're within that buffer zone at the maturity rate. So, if it's, again, if you get 15% protection, if it's 14%, you're going to get a positive 14.
Wow.
But if it's 16, it flips the other way and you lose 1 because you're now beyond that buffer level of protection.
So can I put anything in that? Can you put anything within that dual directional? In other words, if I want the core select, or is it just tied always directly to an index? Like
it's always defined. Yeah, it's a predefined index that's in there, and it's usually a publicly traded index.
Sure. Okay. I just wanted to, for the
That's
layman,
absolutely
the person. Yeah.
And one of the things we do, Tony, is obviously when a client signs up for that, they're going to know the exact index, the exact terms that we're actually recommending that they actually invest into.
That's a good
and then, obviously one of the things that I think people are always looking forward to is, up to this point, we've talked about growth. Really, what we're talking about is being able to accumulate. But at some point in time, some people might want to start looking at income coming in as well. And we have one, strictly designed for that too, Jeremy. I want you to kind of just talk about the way that one works and how you can get some type of quarterly distribution with that as well.
Yeah. It's a great point because it's, again, different clients have different needs, right? Some are going to want, take the shot at market growth and have that level of protection. Other people want a recurring payment. And income to replace their check if they're going into retirement, that kind of thing. So we offer an income-oriented note that is called our designed income offerings. And again, similar indices, similar indexes, the S&P 500, the Dow Jones, the NASDAQ, these kinds of things. But I always like to use, again, getting into a product sometimes can get difficult. So I always like to use the situation as much more of a way to explain it. Is I always call it an as long as portfolio. And so the designed income will pay you a recurring coupon. And we've got 2 offerings right now, one paying 7.5%, one paying 9.25%. And as long as those indexes don't fall below their specified thresholds, which I'll get into here in a second, you will get that coupon payment.
Wow.
So it would be annualized. So let's say, let's say it was 10%. Well, you would get 2.5% every quarter as long as the market didn't fall below their specific thresholds. And we have what's called a coupon barrier threshold and a principal barrier. So these are important to know. They get a little wonky, but here's the thought is that really with the coupon, if the market at the coupon payment date falls below that particular threshold, and then sometimes, with that higher coupon one that I talked about before, the 9.25, that's 25%. And then our lower coupon, that one, has greater protection. That's 40%. So as long as the market doesn't fall below those thresholds, whether it's 25% or 40, let's use 40 as the example, right? As long as the market doesn't fall below 40%, you're going to get that coupon payment. If the market were to fall below that at that coupon payment date, you forfeit that coupon. That is the risk you take on the coupon payments, is that if the market falls below that specific level, you lose that payment. But let's say then the next quarter, when it comes out, that you're back above that threshold level, you'll start getting payments again. You'll lose the one that you gave up, but you also start getting payments again. It doesn't mean you lose all the rest of them. So that's the coupon risk. There is also principal risk that, over a 3-year time frame, that's where how often, that's the maturity of these designed incomes, is over that time frame. At the end, only time it matters is at maturity, is if the market is below that threshold level of principal protection, whether that's, let's use 40% as the example here. If the market is below that, you do experience principal loss. So the risk you're taking to get that premium income component is that at the end of the maturity date, the market is down more than 40%, which is, can happen, but is quite rare over 3-year time frames. So from that perspective, that's the risk you would have, is that you would experience the level of loss of the markets if it fell below that threshold. So there's some risk that entails here. That's how we get the premium income, right? Is when you're talking about 7.5 or 9.25% income, it's a lot higher than what you would get from a treasury or these kinds of things. That's why it's part of the overall risk strategy. It's not the entirety, right? You're going to mix some very safe assets with these kinds of things to get the income you need. This is part of that plan. Does that make sense, Cory?
It does make sense to me. Yeah, and again, I think the big thing to probably understand for our listeners and viewers out there is basically we have 3 different types of products when we start talking about buffered index, and depending on where you are in your life and what you're really trying to accomplish, then we'll try to find the right type of product for you. But it's a great way to be able to generate income if you need income, and it's also a great way to be able to get some accumulation with some type of protection, depending on which way we actually want to go as well, and how much protection you really want. That's something that, it's very easy to talk with a client and say, hey, do you want 100% protection or do you want 20% protection? And based off of that, you kind of understand the terms. Yeah. But, what I would, for anyone out there that wants to learn more about it, I just highly recommend you give us a call at 614-760-0670. Or you can always visit us online at safeharboroh.com to schedule that complimentary, no obligation meeting with us. So, Jeremy, I want to thank you for your time today. We'll have you on maybe talking about some other type of products, or different types of portfolios that we have here in the near future as well. So, for all of our listeners out there, again, if you want to schedule a complimentary, no obligation meeting with us, just give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com.
All right. Well, again, thank you, Jeremy. Great show today. Cory, great to get Jeremy on your show today. Cory, thanks for having me on. It's always good to have Jeremy Bryan on the show. And that does it for today's episode of Financially Fit Radio with our host, Cory Sickles. All right.
All right.
Thank you for listening to Financially Fit Radio. Don't pay too much for taxes or retire without a sound income plan. For more information, contact Cory Sickles at Safe Harbor Retirement Group. Call 614-760-0670 or visit their website at financiallyfitoh.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.